We've all heard about investing, and you may have even weathered a conversation about stocks and RSPs, yet more Canadians own cats than a comprehensive financial plan, and few are confident in their financial knowledge. So before we go into the details, let's start from the beginning. Hi, my name is Avoin Mol, and welcome to Avoin Mol. Let's go over the basics. What is investing? Well, in short, investing is the act of using your money in a way that earns you a return. Investments come in a variety of forms, but most people use what we refer to as securities or investment instruments. These are things such as stocks and bonds, issued by the company that you decide to invest in. These instruments define the rules of your investment, including what you're entitled to and how you earn your return. Your return is the money you earn on top of what you've committed, typically represented as an annual percentage. For example, if I invest $50 at the beginning of the year and earn a 10% annual return, at the end of the year, I'll have $55. This return isn't guaranteed and depends on how your investment performs throughout the year. If a company does well, you will likely earn money, but if it struggles, you could lose money. Clearly, investors want to maximize earnings while minimizing risk, which brings us to the first fundamental relationship in investing, the risk-return trade-off. Some investments pose a higher risk than others, but higher risk investments are generally required to achieve higher returns. In other words, we must balance how much additional risk we are willing to take to achieve higher returns. For example, imagine two investment options. One has a 50% chance of earning 5% and a 50% chance of earning nothing, while the other has an equal chance of earning a positive 15% or a negative 10%. If you wanted a total positive return of 10%, you'd have to invest some money in the riskier option, since the safer one can't achieve this. To lower risk, investors use diversification, a key investing technique. Diversification spreads investments across multiple holdings to improve the overall risk-return trade-off. In simple terms, don't put all your eggs in one basket. Spreading investments decreases the chance of multiple losses at the same time. Diversification works best when investments are uncorrelated, meaning they move independently of one another. For instance, investing in two car manufacturers may be risky since their performance could be correlated. But investing in a car manufacturer and a pharmaceutical company creates a more balanced portfolio. Diversification and the risk-return trade-off are fundamental concepts you should always consider when managing your finances. We'll explore them further later, but for now, this basic understanding will suffice. So why is investing important? For many, it's essential to reach financial goals like buying a house, taking vacations, or most importantly, funding retirement. When you retire, you stop earning an income, so you need money to cover expenses. Luckily, there are tools to help. Employers may offer pension plans, and in Canada, programs like the Canadian Pension Plan and Old Age Security Supplement Retirement Income. But not everyone has full access to these. A large chunk of your retirement will come from your savings, which may need to be more than expected. For example, if you aim to retire at 65 and want $600,000 saved, ignoring inflation and assuming no government assistance, that would provide $24,000 per year if you live to 90. To reach this goal with just your income, you'd need to save $15,000 a year, or $1,250 a month for 40 years. That's not feasible for many, and inflation makes it even tougher. Inflation raises consumer prices, meaning your money loses purchasing power over time. For instance, in 2016, the inflation rate was 1.43%, meaning prices, including rent and food, increased by that amount. This is why investing matters. It lightens the burden of saving while maintaining your money's value. Many people delay saving, assuming they'll catch up later. But the key lesson is, nothing makes reaching financial goals easier than starting early. This is due to compounding, which we'll explain with an example. Suppose you invest with a 6% annual compounded return. Starting at 25, you'd need to save just under $3,900 a year, or $323 a month to reach $600,000 by 65. Compare that to starting at 45, where you'd need over $16,000 a year, or $1,300 a month. Start at 55 and it jumps to $45,000 a year, or $3,000 a month. Compounding, earning interest on interest, makes this possible. If you invest $100 at 10% annually, your first year return is $10. In the second year, you earn $11, because the 10% now applies to both your initial $100 and the $10 earned. By year 3, you earn over $12, then $13, and so on. The longer you invest, the more exponential your growth. Starting early makes investing easier. waiting makes it more expensive. Unfortunately, many Canadians learned this lesson too late. In 2016, the Broadband Institute reported that roughly half of non-pension earning Canadians aged 55-64 had savings representing less than 1 year of retirement needs. Clearly, delaying isn't an option. Take time to learn how to save and invest. It can make a huge difference in your future. And hey, we'd be happy to help. If you like this video, leave a like and subscribe. If there's a topic you'd like us to cover, leave a comment below. For Avoin Mol, I'm Avoin Mol. Thanks for joining me today.